For the latest market moves, we want to welcome in Kevin Mahn. He is Hennion Walsh, a Chief Investment Officer. Kevin, it's great to see you. So it seems like, at least judging from today's market action, many investors are staying on the sidelines right now ahead of tomorrow's results. What are the broader market implications from Nvidia's results tomorrow night?
Yeah, it's clear to me that Wall Street is anxiously waiting to see if Nvidia will bring more joy to investors after they report earnings tomorrow. I think they will. I think they will once again exceed earnings expectations. They'll exceed revenue expectations, and they're going to announce substantial growth in their data center business. Data centers, which of course their CEO refers to as AI factories. In fact, I think Nvidia is positioning themselves to be the hub of the AI ecosystem in a similar fashion that Amazon became the hub of the e-commerce ecosystem.
Do you, Kevin, having said that though, Nvidia's obviously enjoyed this very strong run. I mean, and even just since early August, it's running hot into that print.
Absolutely.
So do you want to own Nvidia here, or when you're playing that AI mega trend, are there other names that you would prefer on your radar?
It's a great question. I wouldn't abandon Nvidia, but I think there are other opportunities in the AI ecosystem beyond Nvidia. A couple names that come to mind, I mentioned data centers earlier. How about a company like Digital Realty? They operate 300 data centers worldwide. They have a joint venture in place with Blackstone to build more data centers, and they have a dividend yield of about 3.25%. Not too shabby. And then I think of a company like Modine Manufacturing. No one on this show has probably ever heard of Modine Manufacturing. What do they have to do with the AI ecosystem? But you know what they do? They supply scalable, efficient, and flexible cooling solutions to data centers.
What about Broadcom? Because I know last time on the show you were pounding the table for Broadcom still.
I still like Broadcom.
Which is, by the way, also had a tremendous run. 90% around in 12 months.
There's more opportunities in the semiconductor and chip space than just Nvidia. It goes higher. It's got a dividend yield of 1.25, and it's got a reasonable forward PE below 30.
Kevin, what do you think the market ultimately needs here in order to keep this momentum to the upside? Because here we are today, not too much movement, but we're right around those record highs. Is it more than just further conviction within this AI trade?
I think it is. The market has already priced in the very high likelihood of an interest rate cut coming after the September meeting. It's not going to be a 50 basis point cut, in my opinion. I think it'll just be a 25 basis point cut.
So boring,
I don't think Powell's going to jump off to that degree.
Why 25?
I think they don't want to go beyond what they've already clearly communicated all the way back in March, when they were suggesting at that time 3 rate cuts of 25 basis points each. We still have 3 meetings left. I think we still get those 3 rate cuts of 25 basis points each, and they'll take a very gradual pace from that point forward until the Fed funds target rate gets back to 3%.
Kevin, should investors be looking at bad news as bad news for the economy, bad news for the market, good news for the economy, good news for the market? And I bring that up because that 25 versus 50 basis point cut debate that's happening right now, many are pushing, or some investors are really pushing for a 50 basis point cut. But we've heard so many people say, you just got to be careful, though, for what you're wishing for.
Without a doubt. It depends on how bad the bad news is. I think the Federal Reserve was very alarmed when they saw the unemployment rate hit 4.3%. Remembering they were forecasting unemployment rate to end this year at 4%. We also saw first quarter GDP come at just 1.3%. If I look at GDP now, right now, the tracker, it's around 2%, below Fed expectations. I think they're more concerned with this economic slowdown turning into a potential recession than they are with inflation staying above 2%.
Kevin, give me you've been watching markets a long time. Give me your grade on Jay Powell, because we've had some very smart economists and strategists come on and say, you know what? The Fed is behind the curve here. The economy's slowing. They don't like what they see with the unemployment rate. What do you think?
I would give him a B plus right now.
It's pretty good.
What we have to remember, though,
it's like my high school average. I mean, that's not bad.
I'm sure you were at least A. You have to remember the Fed is data dependent. So by definition, they're always going to be late to the party. And the Fed is trying to cure a problem that they didn't necessarily create. And I think back to the 1970s. Yes, I'm old to remember that point in time, when Arthur Burns actually started cutting interest rates prior to inflation getting back to their 2% target. What happened back then? Inflation came roaring back, hit double-digit levels. Paul Volcker stepped in, raised the Fed funds target rate to 20%. We think 5.25% is restrictive. Can you imagine 20%? That killed inflation, but it also brought on a recession. That's what Chair Powell is trying to navigate right now, and it's not an easy job. I wish he would have cut at the last meeting. I think that would have been the appropriate time to start the rate cutting campaign, but he didn't, and he didn't ask for my vote, surprisingly.
Do you think we're going to see, well, you never know. You know, maybe you are just one phone call away. After all, Kevin, let's talk about what is already priced into the market, because I think that is another big question here for investors. When it comes to those rate cuts that we are expecting, has that fully been priced in, or to what extent?
I believe certainly a cut in September has been priced in. I believe 75 basis points in rate cuts has been priced in. I don't think 100 basis points in cuts this year has been priced in. But I look much longer term. As I said before, I don't have a crystal ball. I don't have a vote on the FOMC. But if I look at what they're telling us in their dot plot charts, rates should be much lower, at least on the short end of the curve, over the next 2 years. If that holds true, rates are lowered, yields are lower, inflation continues to moderate, that should be good for stocks, that should be good for bonds, and that's how investors should be positioning their portfolios now for what's likely to take place over the next 2 years.
You can't leave without talking politics.
Oh boy.
I know you're excited to.
Check,
Let me ask
please.
you this. Do you look at the market, can you look at the markets and think, you know what, they're signaling or suggesting in some way who wins in November?
To a degree, right? Certain sectors of the market will
How
benefit
so?
from one party over another. But I believe, based upon all the data that I see right now, that in all likelihood, we're going to have a divided government coming out of this election.
Is that what the market wants, by the way?
That's what the market wants, because what that means, Josh, is that there's no major significant legislation that'll get passed, and a lot of these tax-related thoughts that are out there right now are going to have a difficult time getting through. So if government stays out of the way, that's generally good for the market.
Is that where you're going with the online?
Yes.
Yeah.
Yes, absolutely.
Kevin, always great to have you on the show, my friend.
Pleasure. Thanks
Love
for having me.
Thank
Good seeing you both.